Hey, good morning, everyone. Marty Missouri here, March 8th, 2023, Wednesday, with your midweek stock market technical snapshot. I'm going to look at the VIX, going to look at the S&P, and I'm going to look at one economic indicator that I've been showing at most of the client review meetings. Talk about what that says about the prospects going forward. Chairman Powell endured the first day of his two-day semi-annual address to Congress. Looks like he got pummeled pretty good. Looks like he must have stood his ground. I didn't get to watch it all. I watched some of it, parts of it, and some highlights. But, judging by the market's reaction, he came in with a hawkish message with regard to their fight against inflation, and he must have stuck to it. So today's day two. We'll see if he continues on that vein and if he's inspired to change his tune at all. I would say the way he came off yesterday was probably consistent with the data that has come out since the last time he had the opportunity to sound off a little more dovish, to the extent that the market loved it. So as I'm sure you know, since then we've had some pretty hot inflation numbers, really hot employment number, and day after tomorrow we get another employment number for February. ADP's number came out this morning. It was ahead of expectations. They revised the previous month higher. ADP, though, doesn't always, as it didn't in January, comport with the BLS number, which everybody pays attention to. So other data points are interesting this week, but we'll hit those when we do the end of week economic update. So I'll start with the VIX, which is in front of you here, and this is that daily chart. And I want to start with this one because this is the one I ended on last time. And recall that previously we had pointed to this, make that a little more palatable, this bullish falling wedge pattern. And what makes it bullish, by itself it's considered a bullish pattern, but it's not for me until we have bullish divergences on the moving average convergence divergence and on the relative strength index, which we did. And so we broke out of that. The VIX tracks implied volatility on S&P 500 options. So typically, not always, but typically when it goes up, stocks go down. So at the time I showed you this, we had kind of an ambiguous look amid the stock market. But I said the VIX says that look is probably going to break lower. And that's what's happened, up until last Friday over a couple of weeks. And then we came back and kind of had a little bit of a channel in here, if you will. And recall last time, I said that the VIX could come down right here and test this, and we still have bullish divergences on these indicators, and indeed that's what happened. And so we bounced hard off of that yesterday. As you know, it looks like the VIX is a little elevated so far this morning. So the VIX still paints right now on the daily chart a technically bearish picture for the stock market in the very short term going forward. Now, looking at my very busy daily chart of the S&P 500, a bear flag pattern here that I tried to draw, I think you could get away with that, completely failed. Because that by itself would have taken us down to that 3,800, which I think is going to be pretty strong support if and when we get there. And so that's gone. We can get rid of that. Normally I would leave it so we could refer back to it, but I obviously for this screen I need to start getting rid of some lines. So again, this was bullish right in here, and again it would really comported with what I think is an inverse head and shoulders pattern right here. And remember, I did this 20 times easily. The neckline happened to be the bear market trend line, broke out of it, and then retested it, and that's very typical. And then you're off to the races. So that was beginning to look more and more technically bullish. Readers of the blog, Monday I gave you just the intro to our own internal commentary on the monthly scoring of our own equity market conditions index. And it still reads bearish, but the S&P 500 technicals actually moved positively. And I was actually basing it across the daily, weekly, and monthly charts, not the hourly chart, which I always show you on these updates. It may come back and retest, the downtrend line and bounce off of that again. Okay, so near term, this is not a bearish setup here, just in the price action. And I'm longer term still bearish. So I'm talking about relative bullishness right here. Doesn't mean it's going to play out. If we're ultimately right, these things are going to break through some pretty strong resistance at some point, and then we're going to plumb those new lows that we still anticipate. So still bullish. However, based on what just happened, not so much. You can see we broke through the 50-day moving average, found support the next day, continued to go up, and utterly lost it right at the 20-day moving average, which has been real important. Now I can go back and show you here, lost it here, tested it, right? Just like this, lost it, had a big downdraft to get to the bear market lows so far, right? Lost it here, came back, tested it, kaboom, came back down until we regained it right here. So, you could argue that this looks like one of those patterns too, and that it's pretty ominous right here. Losing the 50-day and losing some more of it today so far, we'll see what happens when Powell starts talking, isn't a good sign either. The fact that the 50-day crossed over the 200-day now, typically over longer term periods, you'd look at this and you'd see this happens pretty frequently, and folks pay way too much attention to it. This is the golden cross when the 50 passes back above the 200. But when you go back, as I've done recently, and looked at it during bear markets, it's rare that doesn't signal the end of the bear market. We'll talk about here in a minute why it's still not our base case, but we have to respect that. And I'm surprised. I'm not seeing, not that I pay attention to that much commentary, but I'm not seeing too much talk about this and how that reads historically during bear markets. So we'll see. The jury's still out. Just a heads up, folks, those of you who have brought us cash that we've been sitting on, we're going to, after the jobs number, and things kind of react to that, and that's this Friday, we've decided we're going to go ahead and not allocate broadly to our core, but pick at the areas that we think are cheap enough right here, given conditions, to add to. And it's, you might say it's just in case this pattern actually plays out and the bear market's over. It's not really that, although that will certainly help to the extent that some of that is in equities. And the equities that we think provide unusual opportunity. And a little of it will be U.S., but definitely some non-U.S. exposure that we want to gain there as well. So clients, look for confirmations over the next week that maybe a small chunk of that cash actually got put to work. So back to the chart, we want to consider what the momentum says. Nothing really bullish or bearish in terms of the slant of these relative to the price. As we speak right now, the S&P is pretty much flat as a pancake. This will be the morning note as well, clients. So just to do the usual, I think a lot of people like this part, that last paragraph, where I say how many of our 35 inputs are up versus down. Right now, 11 are down, which means 24 are up. The leaders are Brazil, and ironically, that's one of the areas we want to add a little to. It's up almost 3% today. Vietnam, number 2 position, up 2%. Chipmaker AMD is in 3rd slot. Mexico is in the 4th slot, and then Albemarle, the lithium miner, is in the 5th spot. Worst performers today are AT&T, Dutch Bros, Amazon, Ag Futures, and J&J. So yeah, jury's still out. It can go in either direction, and I suspect we'll get some movement today on Powell's testimony. I highly suspect we'll get some movement, maybe some not small movement, on Friday's jobs number. The 60-minute chart, we'll just jump on there. I'll do that one quickly. So mounted an attempt to break back into the lower end of this consolidation area. Remember, we were bearish coming out of that, but here, right, here we had that bearish wedge pattern, or that bullish wedge pattern, and then we had bullish divergences, kind of even extended out here, and then broke out of that nicely. Lost it right there. These just pretty much comport with price patterns. In fact, this I wouldn't say that the action here on the very short-term chart is bearish right now. So ambiguous look right here in stocks, bearish look in the VIX, and let me finish up with this. So Our own economic index, one of the 45 inputs, is the leading economic indicator to coincident economic indicator ratio. So when it goes down, leading indicators are falling more rapidly, if you will, or they're underperforming coincident indicators. Leading indicators are things like hours worked, jobless claims, ISM new orders, building permits, stock prices, credit conditions, credit spreads, consumer expectations. These are things that give you signals as to where the economy is going. Coincident indicators right now, non-farm payrolls, personal income right now, industrial production, and manufacturing and trade sales, right? What's going on as we speak. So when new orders and hours worked and everything are on the decline, and these are holding up or these aren't declining as much, that's an ominous signal when this rolls over like this about where the economy is going. Okay. And some people just focus on the leading indicators. We just get a little more nuanced here with this. So, we do have periods where we have corrective action here, but we tend not to have periods where we precipitate to this degree, right? And that wasn't even to that degree, but that was COVID, right? The red shaded areas are recessions. So to this degree without recession, historically, pretty much doesn't happen, right? Pretty much doesn't happen. So this could be absolutely 100%, could be false. We could come out of this, I'll say by some miracle to exaggerate, but it looks like this means recession is probably coming, which is what the current scoring of our PWA predicts as well. Now, why this is so important as it relates to the stock market is the orange line here. Unfortunately, this particular data point isn't available to us previous to 1993. What this is earnings in the aggregate on the S&P 500 index. So as you might imagine, right, when the economy is in recession and everything's contracting, well then earnings are contracting. Earnings are contracting, right? Earnings are contracting, right? So this is that Wile E. Coyote cartoon I played around with a couple of weeks ago. So here we are. Here's the edge of the cliff, and here's Wile E. still kind of spinning his legs out above that. So if we get the red shaded area, history says pretty conclusively, and it makes sense, just logic, right? We're going to get this as well. Okay, so the first leg of the bear market that hit our target, which is 3,500 that we set before we had recessionary conditions, that's been had. And that was stock valuations declining, as they almost have to, in response to higher interest rates. That was about all the market needed to do to discount the higher interest rates. A bear market that's got two legs is a recessionary bear market. And the second leg is the earnings recession, the earnings declining. Clearly, stocks are not pricing that in. So this is why we have to remain cautious, despite that technical bullish pattern that typically spells the end of a bear market. So this would be, general conditions. And here is just a simple example, but a very vivid example of why investors should hedge if they know how, like we do with options, own some defensive things like treasuries and some gold and that sort of thing. Very, very, very diversified macro portfolio, which is what we're doing right now. If and when this happens, I am bullish in a not small way, long term, in different places than we made a lot of money on during the previous bull market. But the global setup, structural inflation, populism, deglobalization, green energy, infrastructure, and everything that goes with that, just to name a few factors going forward, are very investable themes, make no mistake. But you don't want to put the cart before the horse when we have setups like this. So folks, let me leave it there. And thank you, as always, for watching and listening. Should have a morning note for you tomorrow, and then the updates on the market and the economy on Friday and over the weekend. Have a great rest of the day. Take care. Bye-bye.